$11 billion vanished in plain sight, not through hacking, but through line items. WorldCom, once the second largest long-distance carrier in the United States, turned losses into profits by moving costs off the income statement and onto the balance sheet. Investors believed the story, pensions followed, and the market applauded while the hole widened. Imagine this was your money, parked in a retirement account, and every quarter the picture looked fine. How do you spot a fraud that speaks fluent accounting? And how did investigators finally cut through the noise to reveal what was really there? WorldCom grew out of a small Mississippi long-distance reseller and rode the 1990s telecom boom by buying rivals at high speed. Founder and chief executive Bernard Ebbers pushed a simple playbook: buy growth, slash costs, and promise steady cash flow as the internet era exploded. The company absorbed MCI, built global networks, and told Wall Street that margins would stay strong, even as prices for voice traffic kept falling. Debt piled up, integration dragged, and sales cooled after the dot-com crash, but guidance stayed upbeat. Behind the scenes, pressure mounted inside finance to meet targets that no longer matched reality, and the tone from the top demanded smooth numbers. Outside, the watchdogs were strained. The Securities and Exchange Commission was already asking questions in early 2002, and the wider market reeled from other scandals. Arthur Andersen, the outside auditor, had been under fire after Enron, and confidence in corporate reporting was cracking. Inside WorldCom, the internal audit team led by Cynthia Cooper faced resistance when they asked basic questions about cost classifications. They saw a pattern that did not reconcile with operations: network costs that should have hit the income statement, as line expenses were appearing on the balance sheet as assets. That switch matters. Expensing lowers current profit, while capitalizing spreads the hit across future periods, which makes earnings look better today. For a company telling investors that cash flow was stable, the temptation to recast expenses as capital was obvious. The internal team also heard a new term: prepaid capacity, used to explain odd balances, yet managers could not provide clear support. As quarters rolled on, layoffs were announced, credit ratings slid, and suppliers tightened terms. But reported profits still suggested control. The gap between the public story and the ledger grew wider, and it would soon force a reckoning. That brings us to the core mechanism that converted losses into paper profits, and why it went undetected for so long, despite many eyes on the numbers. Here is how the scheme worked in plain language. Telecom carriers pay recurring line costs to other networks to carry traffic. Those are normal operating expenses and should reduce profit in the period incurred. When revenue sagged, finance leaders directed staff to classify billions of those line costs as capital expenditures. By moving the costs to the balance sheet as assets, the company avoided recognizing the full hit to profit. Later, those assets would be depreciated over time, spreading the damage across future quarters and smoothing results. That switch transformed a real loss into a paper profit. It also boosted reported cash flow from operations, because cash paid for line costs appeared as investing outflows instead of operating outflows. The second lever involved reserves. Companies build reserves for bad debts or merger costs. If those estimates are pushed too high in one period and quietly released in a later period, earnings can be topped up without a true improvement in performance. At WorldCom, internal investigators and the Securities and Exchange Commission later described billions in unsupported or false entries that used both tactics. Scott Sullivan, the chief financial officer, allegedly approved the reclassifications and directed staff to find ways to meet targets, while controller David Myers and general accounting personnel posted topside entries near quarter end. Documentation was thin, explanations shifted, and the numbers always landed where guidance needed them to land. When internal audit asked for support for prepaid capacity or for unusual capital balances, they met delays and pushback. To avoid tipping off systems administrators, the audit team pulled data after hours, traced account strings, and mapped the flow from expense lines to capital accounts. They tied the entries to specific quarters and showed that without those switches, a reported profit would have been a large loss. That evidence forced a confrontation with senior leaders and the audit committee. Once confronted, resignations followed, and the company disclosed that income had been overstated by more than $3.8 billion over 5 quarters. Further review raised the total overstatement to more than $11 billion, as investigators found additional capitalizations and reserve manipulations stretching across multiple years. The outside audit firm, Arthur Andersen, was under intense scrutiny and was in no position to restore market trust. Creditors and customers saw risk rising, and liquidity tightened even before the final numbers were known. This is why the fraud was so potent. It did not rely on fake customers, forged invoices, or exotic derivatives. It relied on familiar accounting tools misapplied at scale, with a tone from the top that treated earnings targets as non-negotiable. If you were an investor reading the statements, you saw comforting trends. If you were inside the accounting system, you saw line costs that should have reduced profit today, quietly converted into assets that would be expensed later. That difference is the entire trick, and it set the stage for the unraveling once the trail could not be ignored. The turning point came in early June 2002, when the internal audit team finished tracing capital entries that had no operational support. Cynthia Cooper briefed the audit committee chair and outlined how line costs were being capitalized to inflate earnings. Requests for backup produced vague terms and circular answers, which deepened concern rather than clearing it. As the team worked through the night to avoid attention, they tied specific journal entries to quarter-end targets and demonstrated the impact on reported profit and cash flow. The picture was simple and devastating. Without the switches, losses would have been obvious, and the market story would have collapsed earlier. Faced with the analysis, the board accepted the resignation of the controller and moved to remove the chief financial officer. Senior leaders briefed the Securities and Exchange Commission, and the company announced that it would restate results for 5 quarters. The disclosure shook a market already rattled by other failures, and regulators moved fast. The Securities and Exchange Commission filed a civil fraud action, demanded sworn reports, and sought emergency relief to protect records and assets. Creditors tightened terms, customers hesitated, and the rating agencies cut deeper, which made an already heavy debt load harder to service. Within weeks, the company sought protection under Chapter 11 on July 21, 2002, the largest bankruptcy in the United States at that time. A court-appointed examiner and a corporate monitor reviewed the events, while federal prosecutors opened a parallel criminal case. Scott Sullivan later pleaded guilty and cooperated. Bernard Ebbers went to trial, and a jury found him guilty of fraud, conspiracy, and filing false documents. He received a 25-year sentence. All the while, internal auditors became central witnesses who walked investigators through the systems, the approvals, and the missing support. The reckoning was no longer about one telecom. It was about whether the public could trust reported numbers at all, and that question shaped the reforms that followed next. The fallout reshaped corporate oversight. Congress passed the Sarbanes-Oxley Act in the summer of 2002, tightening internal control reporting, requiring chief executives and chief financial officers to certify financial statements, and increasing criminal penalties for false disclosures. The law also created the Public Company Accounting Oversight Board to inspect audit firms and set standards, a direct response to failures at Enron and WorldCom. Audit committees received clearer duties, whistleblowers gained protections, and auditors faced strict limits on consulting work for audit clients. For WorldCom itself, bankruptcy proceedings unwound claims, replaced new leaders, and prepared a relaunch under the MCI name. The reorganized company later agreed to settlements with regulators and investors, and it was ultimately acquired by Verizon in 2006. Bernard Ebbers served time before release on health grounds, while Scott Sullivan accepted a plea and a bar from serving as an officer or director of a public company. Thousands of employees lost jobs, suppliers took losses, and pension funds wrote down holdings that had once looked safe. For many, the real shock was not a new trick, but how easily familiar concepts like capitalization and reserves could be bent to hide a downturn. The scandal reminded the market that tone at the top matters more than any checklist, and that simple tests can cut through a polished story. That brings us to the takeaways you can apply when the next impressive growth narrative asks for your trust. First, follow operating cash. If profit rises while operating cash shrinks, ask why now. because reclassifying costs can inflate earnings without real money. Second, watch the line between expenses and capital. When routine costs become assets, margins may rest on tomorrow's depreciation, not today's performance. Third, test vague labels. Terms such as prepaid capacity or one-time adjustments must have schedules and approvals you trace. Fourth, check tone at the top. When targets are treated as fixed, controls bend. Fifth, scan footnotes on reserves. Very big swings can turn a miss into a meet without better sales. If you want to see more scandals exposed, subscribe to Money Mystery. Share this video to warn more people, and tell me which case to investigate next.